Hey everyone, I hope that you're doing well. Yeah, I probably look a little bit younger than the last video you watched because the beard is gone. But what we're planning to do in these videos is to go through the tutorials and questions as they relate to donations tax and estate duty. These ones are actually going to focus more on donations tax, and then we'll have a couple more in-depth on estate duty. So let's get right into it, shall we? I'm going to move this to the side here so you can see me. And we're going to carry on doing the intro to donations tax and estate duty example. So this is just a very, very short example question just to show you what the basics will look like for each of these. And the information that you're given is you're told Sashaba did the following in order in the 2020 year of assessment. She allowed her mother to live in her home free of charge, and you're given the cost of that per year. Paid for an overseas holiday for the son. Wrote off an interest-free loan, gave the usufruct in a property to her brother. You're given a table. When you get to the end, it says, hey, please calculate the amount of donations tax payable on each donation during the year and give a reason if a transaction has donations tax. I see that says 2, it should say 3. And yeah, so let's have it, or it should say 1 and 2 actually. So let's see what's going on here. Remember, for donations tax, what are we looking for? We're looking for certain things. We're looking firstly to see, is there a donation? If there is a donation, remember, donation, a gratuitous disposal of something. So you're giving away something of value and you're not receiving anything back. Or if you are receiving something back, the value you're getting is too small, not enough, inadequate. Then there will be a deemed donation on the difference between the two. Okay, so now that we've done that first thing, she allowed her aged mother to live in her home free of charge. She estimates that the cost to do so is $64,800. So, two things you should be thinking about. Firstly, is this a donation? And then if so, what is it valued at? And are there any exemptions? Now, I would start off to say, if you just let your mother come stay in your house, it's not really a donation because you're not really giving anything away. What it's referring to here is actually letting your mom stay in a home where you aren't living. So you're in effect donating the use of that house, i.e. not charging them rent. So I think it is clear that there is a donation here. The value is given to you as $64,800 per year. It could have been given monthly, i.e. just could have said rent is this much per month, okay? But I think it's quite obvious that there is a donation. The issue here, though, is that this is definitely a donation for maintenance. And you know that any donation for maintenance is going to be exempt. So for query 1, the first part, maintenance of the mother, is definitely exempt due to maintenance, okay? When we get to number 2, she paid for a 2-month holiday overseas undertaken by her son who had graduated from university. This cost her 63,000 Rand. So that's a nice expensive holiday. We hope it's not taken now because then he would be stuck overseas. Random bit of info if you're watching this in 2020. So this is addressed to my 2020 class. If I had taken that holiday, I realized I would have actually gotten stuck in the Philippines. Which would have been slightly scary because I also read that they were instructed to shoot on sight if anybody was disobeying the curfews. So I wouldn't have planned to do it, but still rather scary. So I'm quite glad I ended up staying in South Africa and at home recording this video. So in this case, the son has a 2-month holiday for worth 63,000 Rand. I think we can quite clearly see this is a donation and it's certainly not going to be maintenance. So what we've got is a donation of 63,000, but we also know that we have the annual exemption of 100,000. It's applied in order of the donations that you make. So you can apply 63,000 of that exemption to this, and there'll be no donations tax. Just remember now, though, that of your 100,000, you've used up 63,000 of it. Okay. Next, she wrote off 3,000 Rand of an interest-free loan that she had advanced to her brother. So this one is very interesting. What happened? She loaned her brother money, 3,000 Rand, didn't charge interest. And then she said to her brother, hey, you don't actually have to pay me that 3,000 Rand back. Is there a donation? Yes, there is. She is in effect forgiving the debt that is owed to her. So that is in effect giving away an asset worth 3,000 for 0. So there's definitely a donation to the value of 3,000 Rand. That's going to go in as a donation. However, we still got our annual exemption. We've used 63, we're going to use another 3, which means we've now used 66, but it does mean that this is going to be exempt. Okay. I want you to, at the same time, think about something with this loan. This loan was an interest-free loan. Now, obviously, for giving the 3,000, that's worth 3,000. But I also need you to think about the real-life implications of giving an interest-free loan. If you give an interest-free loan to somebody, what is that going to mean for the interest that you're not charging? If you'd given it to anybody else, any kind of non-connected person, any kind of non-special transaction, you'd definitely be charging interest. So the question you should be asking is, well, is granting an interest-free loan actually a donation? And the answer is yes, it certainly is. You're going to have to work out the value of what the interest should have been at the official rate, and whatever you don't charge is going to be a donation. Okay. Otherwise, what you could do, instead of actually just donating money to the person, you just give it to them on an interest-free loan and then forgive the loan up to 100,000, and you can transfer money quite easily that way. Or you give them money, you don't charge interest, they invest it, earn the money, give the money back to you, and then the original capital amount, and then they get the interest. That would be a good way to get rid of or over donations tax. That's not going to work. So remember, granting an interest-free loan is actually going to have some donations tax consequences as well. Great. The last point that we had in part 1, it says she gave the usufruct in a property of valued at 500,000 to her brother, who's 40 on the date of donation. She had donated the bare dominium to her son previously, and she was 45 years old when she made these donations. You then have her age next birthday, her brother, and her son with their life expectancies and the present value factors. So the key things that you need to look at here, the bare dominium was given away in a previous year, so we're not too worried about that. What we are worried about is valuing the usufruct. So the stuff that we have to remember, we told the property is worth 500,000, and when valuing a usufruct, the process that we have to take is to say, well, hey, what we do, annual value, 500,000 times by 12%, so that's 60,000 Rand a year. We then multiply that by the age next birthday of, I'm going to go up here quickly, either the person donating it or, being in this case, Sechaba, or the person who is receiving it, in this case her brother. Over here, the present value factor is going to be the lowest for the brother, so we will take the 8.01, multiply it by the 60, and that gives us the value. Now, you may be asking, do we actually have to do this calculation? And the answer is no. Most of the questions in the textbooks, unfortunately, still do it the old way, where you have to work it out, because the textbook isn't only aimed at students, it's aimed at professionals, it's aimed at people doing non-psych ed degrees. So just because psych ed says you don't have to calculate it, doesn't mean people don't have to calculate it. So I'm showing you the process, but what it would actually probably look like in a question that I would set for you, I would give you this table with another column saying calculated value, and you would have to pick from those calculated values. Okay. Once this is all over and done with, you will see, well, there's the value of the donation. So we take the 480. How much of the annual exclusion do we still have left? Well, we started with 100. We have to take off 66 because we used 63 over here and we used 3 over there. So it's the 480 minus whatever is left here, the 34,000, gives you a number. Multiply that by 20%. If you had more information, and you'd actually been given dates and asked to calculate when the amount was due, what you would have to do is say, well, hey, we apply the 100,000 to this one first because they're in order. We multiply it by the relevant time and date, and we work out when X amount is payable. Remember, donations tax payable at the end of the month after the donation is made. You don't have that information, so it's not needed here, but I hope that you're getting the basics from this. Next. Part 2 is going to look at the very basics of estate duty. So let's get right into it. Tragedy struck Mark Roberts when his wife May was killed in a car accident. She was 52. They married out of community or property, and she left the following assets in her estate: a house, shares, debentures, an insurance policy, a second insurance policy, and then the following payments were made by the executor of her estate: final tax liability, funeral expenses, and the fees of actually doing the estate. She made the following bequests under her will. She gave X amount to a qualifying university to establish a bursary fund, and the rest is given to her kids. You're asked to determine the estate duty payable. So I think this one's actually quite a bit easier than the donations tax. What we have to do, well, when you die, you simply add up the value of all of your assets, because you're looking for the gross value of your estate, take off any allowable deductions, take off your abatement, and then work it out. So let's see. Property goes in, 2.5 million. The shares go in. Remember, all assets are going to go in at their market value if they're not sold. So if they're given to somebody, they're going to go in for the value at which they are sold if they were sold off and the cash given to somebody. The only exception to that is going to be shares in a private company. They're always going to be at market value, so these go in at market value. The debentures go in at the price they were actually sold for. Then we have to think about insurance policies. Okay, the two insurance policies that we're given in this case: an insurance policy on her life, that's all you're told, so straightforward, it goes in. A second insurance policy was given to the husband under antenuptial contract, therefore you know that's going to be excluded. Okay, remember, with insurance policies, you're always looking for scenarios where it's over the life of the person who's dead. Obviously, that's why it's getting paid out, but somebody else was paying the premiums. If that's the case, always look out for that, because there's a possibility you're going to reduce the value. Great, so we stick in the insurance policy, we add it all up, we take off the allowable deductions, in this case debts, which was your tax liability. It's a local debt, so it's fine, it can come off. Your funeral expenses, your executor fees can all come off. And remember, if you leave anything to a qualifying entity, something like a PBO, anything like that, you're going to be allowed that as a deduction as well. Add this all up, you get to 9.8 million. Then take off your abatement of 3.5 million. There's no mention about anything else about previous spouses, so you don't have to worry. Gives you a net of 6.3. Multiply that by 20%, and that is your estate duty payable. The amounts don't exceed the threshold, so you don't have to worry about 25. And yeah, this question was just to show you the process. Very, very basic. Nothing too difficult here. The stuff you need to start thinking about is, well, what happens when there's more items? What happens when stuff starts to become foreign? When there's foreign assets, foreign liabilities? What happens when somebody else is paying for the policy and it's not as simple as this one? What happens if there were previous spouses and you could use some of their abatements? What happens if you exceed the threshold and a portion is going to be at 25%? Okay. At the same time, you need to start thinking about, well, what happens when you die is that you're also deemed to dispose of all of your assets at market value. So you're going to have to start thinking about the CGT on certain assets, as well as the estate duty effects for what goes into the estate. Okay, so that is the video for the intro example. I hope it cleared up a few things. Just remember, this is probably a little bit under exam standard, but it is a good introduction. Great.